Welcome to the Source of Commercial Real Estate. I am your host, Jonathan Hayek, and this is where we talk to the experts in non-residential commercial real estate so you can grow your business, find a competitive advantage, and use real estate to live the life that you want. I am your host, Jonathan Hayek, as I said, and today I am talking with Spencer Strong. Spencer brings a wealth of experience in real estate. He's been directly involved in over $150 million of acquisitions and dispos across 10 states and retains ownership in over 750,000 square feet of commercial properties. He has an undergrad in finance from BYU's Marriott School of Business. He's a partner on multiple shopping centers, as well as a large industrial park that will be a future redevelopment. And so I am really looking forward to talking with Spencer today about all of this. Spencer, how are you today?
Doing good, Jonathan. Thanks for having me on.
It's great to have you here. Spencer, why don't we start out with you telling us about your background, how you got started in real estate, and what your work looks like today?
Yeah. Really, real estate for me, I always just saw kind of the residential side with realtors and never wanted to be the weekend warrior or 8 o'clock at night doing showings and stuff, but got involved in a real estate association through college and understood the commercial realm. There was so much more to it. And so ended up jumping on a team at Colliers right out of school, did investment sales, primarily in the retail space, probably about 70% retail shopping center, but also some multifamily deals, industrial deals, dabbled a little bit in self-storage, but got kind of involved that way on the broker side. And then, longer term, obviously wanted to get more in the principal role and transition away from just transactional real estate. So last year, just was able to syndicate a handful of deals and syndicate another one earlier this year, and just kind of transition away. Happened a little quicker than I thought, but excited about where we're at today and what we've been able to accomplish and what we're hoping to accomplish. So found some great partners who have helped me get to where we're at, and just looking to continue to grow our portfolio.
And are you still brokering commercial deals, or are you full-time on the investment side?
So I left Colliers back in June of this year. I still have an active license, and one of my partners is still active with Colliers. We have a couple multifamily listings here in Utah that we're hoping to offload. We were hoping to have them done earlier in the year, but it's been a little bit of a weird year with interest rates and market conditions and things. So we're hoping to close out one of those late January, maybe into February, and then really move away. But day to day has pretty much moved away, just sourcing deals for ourselves, having conversations with capital sources, putting those pieces into play. So trying to get entirely away from brokerage, but I got a couple deals that just can't seem to get away from.
Spencer, you had a really interesting LinkedIn post within the last couple weeks, and this was sort of talking about your decision to transition from brokerage to being a full-time investor. Can you share that story? I think your post said it was the story that changed your life. Would you mind going through that story?
Yeah, for sure. So, brokerage, there were a lot of benefits. At the end of the day, you don't necessarily have a 9 to 5 or a boss, right? So there's some entrepreneurship involved with that. But I realized on a large transaction that we spent probably about 6 months on, negotiating through a lot of the initial questions and diligence of buyers and filtering through offers and collecting LOIs, moving forward on an LOI, getting a purchase agreement negotiated, and just spent a lot of time on the deal, and ultimately got to a point where it was ready to execute PSA, and our seller decided they weren't going to transact. They said, "Hey, we're just going to hold on to the asset." And that to me was a pretty pivotal moment. I was like, man, I might have some entrepreneurship freedom, but I don't have control. I'm not a decision maker. And that was really a catalyst for me in helping me realize I want to take more control back and get away from just having someone else, have all of the power. And so that was big for me. And really, probably a month after that is when I left Colliers and decided to just hone in entirely on the syndications, and ultimately a fund is the goal. But it's just one of those moments of big realization and reflection of you're staring down the barrel of an exciting opportunity, and then it's kind of taken away by after everything you've done. And so I think I just reflected a lot, and that was kind of the straw that broke the camel's back, right?
I think the theme of that is really common for people that have transitioned from outside of full investment to being full-time real estate investment, and that is we want to be in control. Whether you're in a W-2 job or your brokerage job, when you're in those situations, you're ultimately not in control when you're dependent on the seller making the decision. So it makes complete sense. I want to ask you about commercial brokers, and if you can kind of bring us that are not brokers into the minds of commercial brokers who do not invest in real estate. They sell real estate all day long, but yet they themselves, many of them, don't
Yeah.
invest in real estate. Can you kind of take us into the minds of brokers and maybe why aren't they more active in the investments?
Yeah, that's a really good question. I think from my experience and talking with, I mean, hundreds of brokers across the country, right? There's a select few who feel like it's competition with their clients, and they don't want to be in that position, right? A great deal comes up, and maybe they have a buyer that it fits their buy box exactly, but it's a great deal, and so they go buy it themselves. They feel like they're not, being a good fiduciary. Um, I'd say that's probably a minor portion, and probably a majority is just you silo in on what you're good at, which is transacting on the deals, putting deals together, sourcing opportunities, and they don't want to get involved in kind of the day-to-day management and longer term headaches that maybe they're trying to solve for their clients, right? I know a lot of times that was a big pitch that we would use to land listings is, hey, these are the headaches that you're dealing with, right? Let's 1031 exchange into a different asset class, or let's just offload this burden of an investment, right? And I think it's real estate investing isn't always perfect, but for me the pros heavily outweigh the cons. But I think there's some brokers that just maybe they hone in so much on those cons to get these owners to sell, that's the picture that they paint in their mind, right? Is that real estate investing is really complicated. I don't want to deal with it. And there's too many frustrations.
So, Spencer, you founded Jupiter Equity Partners. Can you walk us through kind of what kinds of deals you're looking at and what is your buy box right now?
Yeah, yeah, for sure. So coming out of brokerage, right, where we would probably about, like I said, 70% of what we were doing was retail shopping center. And when I say retail shopping center, it's more specifically your mid to big box Ross, TJ Maxx, Home Goods, Five Below, grocery anchored. Those type deals are what we hone in on. We feel like they're very stable. You have credit tenants in there, big balance sheets. They're long-term leases, triple net leases. So we really like those, and they fit well with our investor profile who just wants, they're preserving wealth. They don't want to take a lot of risk, and they want cash flows. And so these deals we're finding typically 8 to 12% cash flows for our LPs. And then our targeted IRR on these deals is mid to high teens, call it 15 to 19%. So they're just really stable deals. And I think, multifamily's had all the hype for the last 5 to 7 years, maybe a little longer. And so everyone's focused there, a little bit in industrial and self-storage. And so there's not a whole lot of attention around the retail deals. Cap rates aren't compressed as much as they are. You're finding good opportunities. And I would say the one tricky part to these deals is you're probably at least 10 to 15 million to find a good one. So they are for sure larger deals. And then also, we love self-storage. I think there's a lot of operational inefficiencies that we try and solve for there. Just hard to find a deal. So if anyone out there has a self-storage deal, bring it over. We'd love to do it with you. And multifamily. I think smaller multifamily deals we like. There's opportunity. We're not, heavy value add players, but I think there's a lot of distress happening in multifamily debt right now. I think we've seen we've been tracking the data from TREP and Crexi and CoStar and other sources showing, I want to say close to 50% of multifamily loans are right at the threshold. They're barely covering their DSCR. So retail's been a focus, but really just looking for opportunities to capitalize. I think a lot of people are sitting on the sidelines in today's market with where interest rates are, but we're trying to buy as much as we can, because when interest rates go back down, I think we're just going to see property values go up. So we want to buy as much as we can right now.
Spencer, I want to go deeper on your big box retail strategy. So first, let's start out. You talked kind of about the parameters of the deals that you look for. What kind of markets are you looking at these deals in?
We're pretty open. I mean, a few of us partners were based out of Salt Lake. I've got one partner down in South Florida. Love the Mountain States, obviously. I think there's great opportunity. Hard to find yield here. Southeast, pretty similar, Georgia, Florida, Carolinas, Tennessee. Love those markets. We've yet to transact down there. Just haven't been able to find a deal that makes the numbers work for us, and we're really excited about. So we've been transacting more than anywhere across the Midwest. Indiana, Wisconsin, Oklahoma, looking at deals in Missouri, Oklahoma, again, other deals, Texas. I think the Midwest has a lot of growth. There are a lot of good markets, and it's not getting as much institutional attention as, a lot of the coastal markets and the Sun Belt has been getting the last year or so. So we're pretty, besides the Northeast and the, explicit West Coast, we're pretty open across the country. It's just finding good fundamentals. I mean, at the end of the day, we're really conservative on our underwriting. We want quality underlying real estate fundamentals, location, traffic counts, growing populations, good industry in the areas that we're buying. But there's a lot of these Midwestern markets that don't get very much attention, which we're okay with. We're okay with not competing with 100 buyers.
So, Spencer, I want to ask you about your business plan for these properties, because typically the returns that you outlined that you're targeting, the 8 to 12% cash on cash, 15 to 19% IRR, this asset type for me personally is not typically what I would think of as bringing in those types of returns. So are these value add plays? Are these mispriced assets? Are you making low offers? Can you tell me about your business plan with these big box retail assets?
For sure. Yeah, I'm glad you brought this up. So we're typically buying pretty stabilized deals. The nice thing that we've seen with retail is it's moved with where interest rates are. Besides your nice grocery anchored centers, right? A Publix anchored center or Walmart or Target, those are still going to trade pretty aggressive. But looking on kind of, the mid to big box, we're just seeing a lot of deals today, call it 8 to 9% caps is what we're looking at buying them for. And one deal in particular, it's only 18 months old. Got 91% credit tenants, 96% occupied, and we're looking at acquiring it for just north of an 8 cap. And these are deals, buying at an 8 cap and securing debt because of credit tenancy. A lot of times our debt quotes are pretty solid, so we're looking at debt around 6.25, maybe 6.4 interest rate, and buying at a deal at 8.25. They're just pretty stabilized. Some small value add component that sometimes we'll look for is, if we've got leases turning over that might be under market, or if there's an opportunity to sell off an out parcel building, maybe a single tenant Aspen Dental or Chick-fil-A or something that's part of the whole picture, but we could trade out of it or build an out parcel or carve the center a little bit. So those are some value add plays that we really just look at as kind of a cherry on top. I mean, we want to buy a deal and just hold it as is and let it appreciate and let the rents increase and those things. But if there's an opportunity for a low hanging value add, then we would do that.
As you're underwriting deals, are you underwriting to a certain exit timeline, or are these kind of hold forever legacy properties?
Yeah, we'll typically underwrite them to give or take 7 years. Depending on the asset, I think the one thing that we are very attentive of, just from a prior experience, are the significant CapEx items. If a roof needs to be replaced, a parking lot, full HVAC system, those items can get very, very expensive. So trying to underwrite a timeline where we're taking into account those items if we would have to do it, or if we do start to get to the end of a useful life of a roof, specifically towards the end of a hold period, how is that going to affect our exit cap and our sale price? Typically looking at about a 7-year horizon is what we'll do.
Can you talk more about your CapEx strategy? I think that is a really interesting idea that I'd like to hear more from you on. So you're basically saying, you've got, 50 or 100,000 square foot property, and these properties have roofs, and these roofs have a lifespan on it. And so you're weighing, if we're going to have to do this roof, that needs to go into your numbers, versus if this has a warranty on it for 15 or 20 years, we should probably sell it before, with enough life left on that warranty so that the next buyer still finds it attractive. Can you talk a little bit more about your thought process with those items?
Yeah, for sure. So this really we bought a deal last year, and it's a great deal. Awesome real estate, just really busy intersection in Milwaukee. We bought it, and the report and the seller both showed that it had about 5 to 6 years of useful life remaining. So we'd accounted for that. We funded a pretty good operating account at closing. I think we put close to $300,000 in it. Excuse me, and we were adding 50 to 70,000 a year into the operating account to get that ready. By the time the roof came due, and we closed on this deal in November of last year, and come January, we were getting a ton of notices from the tenants of just lots of consistent leaks. And it was a decently harsh winter last year, but 5 years to 2 months is a pretty big discrepancy. So we ended up having to engage a contractor to get the roof started and redone, because the city was actually sending notice from us or to us, and the shopping center was 175,000 feet, give or take, and the roof costs close to $1 million. And so really just significant CapEx, right? To have $1 million sitting around, you're not going to have that much sitting around, right? Unless day one we're going to do the roof. And so luckily we'd accounted for, we had a few $100,000 in our operating account. We've been adding to it, and the center cash flowed really, really well. And so it's a setback, but it doesn't, we're pretty conservative on everything else. There's an opportunity to add another out parcel to make up, a lot of that value, well, really all of the value that we lost in the roof. And so I think from that experience, we're just so much more attentive to roofs and CapEx items now moving forward. And taking the third party reports and the seller's word at, I guess, discounting it a little bit, right? We want to get a few sets of eyes on it before we buy an asset and look at those items. So just really, there's not a whole lot with shopping centers where you would expect to pay a lot, but the roof is one of those things. So I think, this other center we're looking at, it's only 18 months old. Roof's going to have 20 years of useful life. So we hold the deal for 7, 8, 10 years. It's still going to have 10 to 15 years left of useful life. And a buyer will come in and see that, and we won't lose any value in selling at that point in time.
So Spencer, I'm curious what you did. You get $1 million bill for a new roof. You've got $300K in an account. Did you just end up financing it?
So we were able to work out some good terms with the contractor. So we are actually able to spread those payments over a 10-month period at 0% interest. So those are spread out. We decided to forego some distributions just to handle that and not have to put a loan or get a loan for that. So it ended up, it will be okay. And we'll make up for that on getting that out parcel developed and selling that off at a compressed cap rate. So overall, I'm confident we'll still hit our returns there. Just a setback. It's something that you have to work through. So that to us is just a testament of, this is why we underwrite really conservatively. We can still hit the numbers that we're projecting to our investors because of funding the slush fund up front and having significant cash flows and these other things that we put in place.
Were your investors, or how understanding were your investors when you brought this up to them and you said, hey, distributions are going to have to be paused for a period of time? How did that go over?
I think obviously there's some frustration, when anything happens that's outside of what the initial expectation was, there's going to be frustration. And we get that. I think our motive though is just always operate in complete transparency. As we understand and as we learn things and as we're figuring it out, it's trying to consistently keep that information in front of the investors, so that they feel like we're a true fiduciary, that we have their best interests. And obviously on these deals, if they're not making money, we're not making money. So our interests are aligned, and that communication is really pivotal and so important to maintain good investor relations through this type of stuff.
So you said that deal was cash flowing really well. So I'd love to ask you some more questions about this particular deal. We've talked about the roof. Can you tell me about where this deal is, who the tenants are, and what the plan is for it?
Yeah. So it's a deal in the Milwaukee MSA. It's shadow anchored by a grocer, a Metro Market that performs really, really well. So we don't own that, but obviously benefit off the traffic. There's a regional gym, a Burlington, Ross, Best Buy outlet, O'Reilly, and then there's 3 small other tenants. I think a Leslie Pool Supply, a cheesesteak shop, and like a little ramen bowl place. So 8 tenants, 4 of which take up a majority of the center, and then 4 smaller tenants that kind of complement. Pretty standard, pretty clean cut. It's on a really busy intersection. It's got a Chick-fil-A that's in the parking lot that brings a lot of traffic. We don't own the Chick-fil-A, but still benefit, right? Everyone knows Chick-fil-A is a huge traffic driver, so still benefit by the attention and visibility that it brings.
Where did you find this deal?
This one I actually found on market. Yeah, so we found this one on market last year, just before the interest rates really started moving. Um, had an opportunity, got it at a good price. I think the seller, their MO, they bought it as a pretty heavy value add deal. Um, and they added a lot of value, got some new tenants in there, and then still a little bit of meat on the bone with the ability to develop the out parcel. Um, Still trying to figure out what the situation with the roof is, right? If there was a little bit more liability from the seller than they let on, but um, yeah, kind of their MO is just adding a lot of that value from a dilapidated center and then leaving some meat on the bone. So they make plenty of money doing it that way, but still provide, a seller a pretty, or a new buyer a pretty ideal acquisition with some opportunity and upside.
And were there, I guess, what's the business plan? Is there any value add? You mentioned the out parcel. Are rents pretty much at market rate? Any expiring leases, or is it pretty stabilized from that respect?
A pretty stabilized deal. The only immediate upside is just that out parcel development, and that's something that we're working on right now. Just having to get a lot of different approvals from tenants and their parking space in the city, and so working on that. I think we're getting closer, and then have
What's
a
your
pretty
hope?
sweet.
What's your hope for the out parcel?
So our hope is really just a single tenant drive through, and we have a few tenants vying for it. One of which has offered a pretty attractive reverse build to suit. So they pretty much handle the whole process, which we love. We just have to get the approvals from the tenants, and then they'll cover a majority of the cost too. So we'll have a few draws that we'll contribute to for that, but hopefully get it built within the next 12 to 18 months, and then we'll likely just sell it out as a single tenant net lease deal.
And I think you had mentioned that you closed on this right before some of the big interest rate hikes. What does your debt situation look like on this one?
Yeah, so debt actually did move up on us while we were in the process. I want to say our interest rates in the low fives. Um, so good compared to where we're at today. Not amazing. It's not 2021 numbers, but we'll take it.
It's not 8.
No, it's not 8, thankfully. So I think we're in the low fives. I think it's a 10-year term. We had 12 months of IO, which was great. Non-recourse deal with a life co.
So, Spencer, I'm curious, what does your team look like? You're part of Jupiter Equity Partners. Who do you work with on these deals?
Yeah, so myself, and a partner with from Colliers. So we partnered up on the broker side and have just kind of transitioned this together. His name's Sage Shepard. Um, Found another partner back at a conference at ICSC in Vegas almost 2 years ago. So we met him through a friend of a friend. Kept in touch for the last year and a half, 2 years. Started having more serious conversations about what we're doing here. His background is really in the development and investor relations side. So he and his family have done quite a bit of development across New York, Miami. They're doing a lot in Brazil right now. They work with a lot of international capital. His name's Nicholas Heron. So he's actually down in South Florida, and he's been our big connector with different capital sources, getting in the room with different people, right? And comes from that background more so in development to understand, kind of source those opportunities, find different relationships from that side. And then one other partner who I'll keep his name disclosed for now, but he is actually just finishing up a Master's of Finance program right now. So his background is he and I did our undergrad together, our bachelor's of finance, obviously, and he got into the fund world and fund management, so understands a lot of the back end SEC compliance, operations, kind of the investor platform, that type of stuff. So the cool thing with it, right, is we kind of bring different skill sets to the table to round out, the full team and the ability to work on the acquisitions and underwriting and analysis and asset management and investor relations, all these different things. No one has to be the master of everything. I think we can all help in everything, but no one's perfect in everything. So we kind of rely on each other for different strong suits.
Definitely a formidable team from what you've described. Spencer, what do you find your role being on the team?
Yes, I think having done kind of the acquisitions and underwriting and then my background in finance, I'm in spreadsheets quite a bit doing our due diligence and underwriting for deals, and just sourcing. So Sage and myself have a lot of relationships with brokers across the country, sellers, owners, and understand kind of how to drum up opportunities, right? We've done a lot of cold calling in our day and continue to do cold calling. I think it's one of those things you can't ever get away from. And maybe it's not the most efficient, but I think it always drums up opportunity. So I think, yeah, for me, a lot of sourcing and then the underwriting and analysis.
Spencer, these are, I know I'm listening to this and I know listeners are listening to this and they're thinking, how can I do deals like this? I mean, finding, some of your deals are on market, 8 to 12% cash on cash, 15 to 19 IRR. That's what I know.
Yeah.
A lot of multifamily people underwrite to. A lot of groups are underwriting to, aspire to have those numbers. And so, I guess, how do you feel like? Yeah, what have been some of the keys to your ability to scale to get to this point?
Yeah, that's a really good question. I think maybe the biggest thing is finding opportunities. I think a lot of the opportunities we come across are either off market or pocket listings before they hit the market. And so we're looking for buys where we have some upside out the gate, where we're maybe not necessarily paying a true market price. And then I think just we're not, we don't have our money sitting in an account. We're not a closed-ended fund, so we're not pressured to deploy capital and buy deals that we don't have to. So I think that gives us an edge in just being patient, right? And waiting for the right opportunities to present themselves, to not get irresponsible. So we're not buying deals just because they're good. We're really looking for great opportunities. We want our investors to have a home run first experience with us, so they want to come back and do more deals together. And so I think just finding those opportunities and using that network that we have and have created aligned with kind of our underwriting process gives us a competitive edge to source and execute on quality deals.
Makes a lot of sense. Spencer, as we head towards the tail end of our conversation, I have a few more questions. They're designed to be sort of rapid fire lightning round, but if you've got a great story or you want to spend some more time on a question, feel free to go right ahead. First question, if you could 10x one part of your business, what part of your business would that be?
Capital raising.
Why is that?
I think we've got the deal sourcing down. It's just continually wanting more capital to scale with the deals that we find.
What's the best deal that you've done?
I'll say best. There's a deal in Indiana that we own that's been completely problemsome, which I like that for the best, right? It's performed just how we wanted to and better. without really any headaches. So we'll take
What's your,
that 10 out of 10 days.
what's your top tip for finding deals right now?
Uh, I think knowing, targeting who you want to talk to, and then getting information right, getting out there and dialing. A lot of them are cold calls. You can't play the lazy man's game. I mean, sure, we get deals brought to us by brokers, but we cold call and we try and drum up opportunities consistently.
And are you cold calling brokers or property owners?
Property owners, direct, yeah.
Have you found deals that way?
We have. Yep. Yep.
What's your top tip for raising capital right now?
Have a good deal. I think capital wants deals, and I think unless you have a significant track record, the best way to overcome that is to have a great deal that people can't say no to.
Has it been challenging raising capital for any of these recent deals?
Yeah, each deal has its own challenges. Yeah, I would never say. I mean, maybe for some people, raising capital is a walk in the park. I think it's always a challenge, but it's part of it. You know, you overcome it, and I think we take care of our investors, and they'll come back, and it will get easier. But I think we're still definitely on that emerging end, and trying to forge more relationships that will take us further.
Is there a book, podcast, YouTube channel, or other resource that has been helpful to you that you'd recommend to others?
I think one book that will always resonate with me, it's called The Go-Giver. And I'm not sure if you've read it or not, Jonathan, but I think when we can focus on the outward and what we're giving back, things naturally come back to us, right? We take away that selfish mentality of I got to get what's mine and me, and focus on that self-centeredness as much as we can give back out. And especially at this time of year, opportunities come our way and we surprise ourselves.
Yep, I read the book earlier this year, and it is definitely it's a mindset shifter of a book, basically of just provide value to others and good things will happen to you. So love that suggestion. And if listeners want to connect with you, want to connect with Jupiter Equity Partners, where would you like to send people?
So LinkedIn's probably best for us. I know we're all pretty active there. We don't really do anything on other platforms, but hoping to get our website up pretty soon. Had some issues with it, so we pulled it down, but fingers crossed we have it up beginning of the year. But LinkedIn for myself, Spencer Strong, and we can connect with the Jupiter page there. The team would be happy to link up with anybody.
That's where Spencer and I, that's where you and I originally connected. Spencer provides great content on LinkedIn, so I'd highly encourage listeners to connect with you on LinkedIn. Spencer, was there anything we didn't talk about, any message you want to get out that you'd like to share with listeners?
I think follow me on LinkedIn and you'll get that. But I think the biggest thing, right, is we're all going through a journey together, and the more we can help each other out and be resources to each other, the better. I think integrity and giving back plays a big piece of who we are at Jupiter. I know that we're directly involved with a few different charities across the world, and I've had a lot of help given to me, and always looking for opportunities to give back at the same time.
Spencer, this has been a great conversation. I loved hearing about the deals that you're doing. Definitely look forward to continuing to connect with you and follow you and learn more about the deals that you're doing. Thank you so much for joining me today.
Thanks, Jonathan.
Listeners, if you enjoyed this conversation, reach out to either one of us. We love talking about commercial real estate, and we look forward to connecting with you. Thank you so much for listening. Until next time, take care.